Who would like to go first?
Paul May from Barclays. A few questions, but a couple of them linked. On slide 7, you highlighted footfall in the RV growth in Bullring as justification for the yield compression. But the footfall was up until 2017. Just wondered what the 2018 footfall in the RV growth has been in Bullring.
Mark, have you got the figure? I think it's slightly positive ERV growth. Footfall?
Yeah, and footfall is we're broadly tracking portfolio slightly ahead of the portfolio average that we've provided.
Paul, because I think it's clear, just to sort of respond to the question as well. So yes, ERV growth right now flat, slightly positive. Evaluation is not about simply that figure today. You know, what we have to estimate, and our valuers importantly have to estimate, what do they believe is the prospect for ERV growth going forwards. So we've explained in a very difficult market in the last 3 years, we've demonstrated good ERV growth. Right now it's quite challenging. We've explained a number of the reasons why, but equally I hope we've explained why going forwards, the depth of demand, the need for brands to have position in these places, ERV growth will come back to sort of the level we've seen in the last 3 years, and that underpins the valuation.
Yeah, and certainly some of the deals that Ian's highlighted, I mean, the team have been particularly active in Birmingham. Tommy Hilfiger, Calvin Klein, following Arket. Certainly on the mid-level, we've been able to push ERVs and tones along there as a result of some of that recent leasing activity. You know, some of those 80% of deals you saw on the chart helped drive that.
Just then a couple on CVAs, well, the 7 million impact in 2018. What's the annualised impact? Because obviously that's grown through 2018. So a full year impact will be larger, I'm guessing.
Yeah, it's on the timer.
Yeah, I mean, it's going to be more because if you think about the weighting of CVAs this year is seeing only part of the impact. Yeah. However, there is backfill. So you've got to think about a gross and a net. So the gross effect on rent will be higher next year, but we will compensate by reletting space, like we've explained with the F&B brands and with other new leasing. So the importance is, if Ian and the team can keep leasing at the rate they are, that helps compensate. So I think if you look at the 2018 impact that we've described, that's probably fair enough for future years, but a lot will depend on how quickly we can backfill.
Okay. And I think you sort of linked to that, and you mentioned in the past a flat to slightly positive like-for-like NRI growth for next year. Is that still the target, or do you think that's going to now be flat at best, given the
well, it's time to tell. I think it's a little early to think about exactly what the prospects for next year is. You know, we've got some leasing to do, for example, now in the final quarter, in the first quarter of next year, and it is dependent on the level of CVAs. What I would say about this year, Paul, I think we said a -1 to +1 range. I think it's looking like we'll be at the bottom end of that range for this year.
So the final one is just clarifying, you mentioned the leasing versus ERV being obviously significantly positive, leasing versus previous passing being relatively flat. My understanding is over the last 5 years your ERVs on average have grown, and I think your units on average 5 years ago were reversionary. So how come you're not getting that coming through in your passing rent over the 5 years in the leasing transactions? I appreciate lots of it is averages, that could be the explanation.
Well, I think that's the point. You know, you're blending together the thousands of units we have to come up with an overall figure, and the leasing figures we give you are based on the units that we are getting back and we're releasing. And therefore it very much depends on, you know, the previous rent of that unit versus the ERV versus the new rent that we achieve. So, you know, it is very difficult to take an average of the last 2 or 3 years and then look at the individual year and try and extrapolate some sort of conclusion from that. But I mean, Timon, would you add anything to that? I think what we have shown you is a sort of backdrop to individual leasing deals, the tone of leasing deals, and importantly that pop-up and temporary leasing point that can depress rents in the very short term, but as Ian explained, drive rents and demand going forwards.
Hello. Just a quick question on UK versus France. Just there's a very different OCR. Maybe you can help us understand what that means for future rental growth in the two markets.
Yeah, in the appendix, we have provided a bit of information on OCRs. Page 36 in your books, it's the final page. So the OCRs in UK shopping centres is 22% versus 14.3% in France. I have to say, I mean, two things here. I've said before, increasingly OCRs are not the guide to you, to us, that they used to be. You know, Ian and Mark talked about the halo effect. You know, that point about John Lewis, independent research thinks that their sales, in-store sales, are understated by approaching 50%. So that figure is really unreliable. What we do is you look at the categories, the individual retailers, we break down almost store profitability, allowing for some of that brand value, that halo effect. Comparing UK and France is even less relevant, because if you think about it, there are different corporate taxes, there are different employer taxes in terms of employees. So the read across in terms of profitability or net margins for the retailers on that number is just apples and pears. So I really, you know, caution heavily about looking at one and the other and thinking, oh, well, therefore, there's higher propensity for growth to come in France. I really don't think that's the case. Sorry, I can't be more certain or detailed than that.
I appreciate there's an apples and pears effect. And I know this is a UK event, but could you give a little insight into France a little bit more, just to say there's a lot of focus about how tough things are in the UK. How are you seeing things in France versus that?
Yeah, clearly you're not seeing the wave of retail failures that you're seeing in the UK, albeit there is a slight uptick in administrations in France. Leasing demand is good, but actually in our market it's not been as strong as the UK, but sometimes that's down to the availability of space. Overall sentiment from a consumer, retailer and investor, certainly the first two is more positive than the UK. Investment-wise, it's quite muted as well. I think overall, though, that my prognosis is that France is in a better place today than the UK, but perhaps we'll give further detail at the full year. I mean, this is ultimately a sort of focusing on the UK.
It's Robbie at Numis. Just one question from me. The £179 average spend on the big day out, can you just break that down by roughly where that spend is going? So put round percentages on food and beverage, bit of leisure, retail, or is that not possible to do with the information available? What I'm trying to do is gauge sort of how that's driving more configuration in your kind of expectations over the next few years.
Yeah, I mean, I would say it's certainly an increasing element of it is relating to leisure and F&B for all the reasons that we've talked about. I don't have the number to hand, Robbie, but it's certainly an increasing trend.
Yeah.
Alex Everett, our head of insights at the back. Alex might be able to have more
There's some
insight.
good work by CACI, which looked at shopper trends over the last 5 years, and what they're seeing is the share of overall shopping missions is that destination shopping is growing, and it's grown by about sort of 30% in the last 5 years, whereas convenience shopping has actually diminished as a share of overall shopping trips in the last 5 years by about 10%. So there are more people going for fewer, bigger days out, and that's where that analysis comes from in part.
Thanks, Alex. Thanks, Rob.
Yeah, thanks very much indeed for starting to provide a bit more information. Just following on from Paul's question about ERVs and the degree of scepticism, shall we say, on this side of the room. The table on page 21 shows the headline rents you've achieved against ERV. Without being flippant, but when it beating or underperforming against ERV by double-digit percentages, why do you bother with ERVs? Because they are clearly miles.
Yeah, well, look, as Ian said, and I think we wanted to provide some colour here, give you some more insight. Yeah, the the trend remains that 80% of those permanent lettings are above ERV. You can see the spread we've got here. We wanted to show a range of those deals and show you, as David said, the good, the bad, and the not so strong. And yeah, the valuers, when they look at this, and when we look and we assess what the right sustainable level of rent someone is going to pay, we take all these things in the round. We take the level of temp lettings we're doing, which are typically below. We know that we can let above in certain categories, and therefore there is an average, a judgment then that's made by the valuers on ERV tone. So I think in the absence of another measure, it's as good a guide, I think, as we're going to give you, Alan, at this stage of the evolution of all of this.
Yeah, I think also, Alan, we've had a conversation previously, retail space is not a commodity. This is not a square foot in a city office building, which has a sort of fairly comparable measure in terms of, if you want space, it depends, micro location, the services, the floor, but you'll come to a sort of a view on rental. And that's quite easy to assess based on the evidence. The difficulty of retail, it comes down to the individual unit, where it is in the mall, the size, the frontage, the return frontage, and also for the retailer, almost the value that they're putting in the frontage, the signage, the brand value. And I think, therefore, for our valuers, this is a really tough job, because frankly, they're simply looking at data that's happened and trying to provide a sense of what that means for other units. I think we have a better idea because of that in-depth knowledge about who we're talking to, their business model, the benefits that they can get, whether it's through click and collect or the brand or whatever that goes with it. And that drives our decisions. But I think, yeah, it's wrong to assume that, retailers have got it right or wrong if they're bidding 40% above the ERV or 20% below. Beauty is in the eye of the beholder in a way. But I think overall, our insight, the demand that's there, and the figures that we're trying to show you, that good and bad, in the round still add up to a very credible proposition.
No, that's fine. I absolutely accept that. I'm just staggered by the variance against ERV.
I mean, on page, in simple terms, on page 20, the butterfly. The obvious thing is we'd want to let every unit to the tenant on the right who's paying, 85% above ERV. But it doesn't work like that, and ultimately, clearly, they think there's more value in the unit, and the valuer has got it wrong for that particular retailer.
Okay, and just minor one, but obviously on page 17 you beat ERV last calendar year, financial year by 4.5%, but against previous passing, that's 1%. Can you give some sort of flavour as to which of those were rent reviews or re-lettings or stuff that you'd reconfigured? And then, really minor point, the average incentive 8 months against 10 months is a figure I recognise from the interim results presentation. The average lease term of 8 years isn't. I rather thought the interim stage average lease length was 5 years for lettings this year. So I wonder whether anything significant has happened in Q3 in terms of much longer leases.
Okay, well, let me deal with that last question first. What we talked about at the last update was the propensity for retailers to be looking at leases 5 years or 10-year with 5-year breaks, rather than it being a portfolio average at this stage. But it's certainly moving towards that shorter term basis. So, I mean, no, things haven't significantly moved in the last 8 months, last quarter to suddenly drive up average lease term. That's generally been the consistent number. The first question, first question around leasing passing rent, just in terms of what you're looking for the breakdown of.
Well, Alan, none of it is rent reviews because this is leasing.
Yeah, okay. Absolutely.
And I think the
what I was getting at is re-letting to the existing tenants.
The breakdown is in proportion to, on page 17, the leasing reconfigurations and temporary. I mean, that gives you a range of the proportion of lettings we've done, and I think therefore you take it to that gives you a guide. The breakdown of leasing versus rent passing or ERV. And we explained, the temps are significantly below ERV, so there's quite a lot of data there.
Okay, thanks very much.
Hello. Come on over here.
Hi, Max Nemo Kempen. I appreciate it might be a little bit difficult to comment, but just on the Highcross transaction, is this kind of like a one-off sort of thing from kind of passive Asian capital, or are these discussions that you're kind of having across the portfolio with other centres? What kind of flavour can you give us on that?
Yeah, I think, look, there is a fairly thin market out there for large lot size retail assets. Where there is demand is certainly for the better quality. I think it's interesting, this Far Eastern investor, this is the first significant investment in retail by them in the UK. We know that there are one or two other Asian investors sort of that around them, if you like, that we think, and from conversations, may well almost be influenced by their actions. You know, sentiment is about activity as well as simply opinion. So I think that could prompt some further interest, and we have one or two discussions ongoing. I think today's news regarding one of our competitors shows again significant overseas commitment, investment potentially in the UK, and certainly the conversations we're having, people are beginning to look beyond Brexit. They're looking beyond the sort of headlines of retail failures, and they are acknowledging that actually there is value here. So come back to our target for next year. We remain confident about that, but equally we continue to look at alternative options about disposals. We're not singularly focused on one asset over here, one asset over there. We have multiple conversations that are ongoing, and we keep open-minded about the target and the target assets that we're talking about.
Thanks. Hi, Jonathan Kaweta from Goldman Sachs. So just to come back to CVAs, you've highlighted the impact up to now. What is your view on the sort of near-term future? I mean, obviously you're following the performance of your tenants.
Sorry, the last bit?
What is your view in the near-term future in terms of any accelerations of CVA or slowdown of CVAs? Obviously we're in the run-up to Christmas, which is an unusual time to go for CVAs. You want to trade up until Christmas if you can.
Yeah.
So do you expect an acceleration post-Christmas?
I mean, historically what you've seen is a seasonality to administrations. Those are companies that have failed. And clearly, cash flow is lowest in the first quarter, first half of the year for a retailer, and that's where you've tended historically to see a spike in failures. CVAs, though, is actually a restructuring of a business that continues to trade. So if you think about it, that can happen any time of the year. And particularly, even if a CVA is promoted where they're going to close some stores, a CVA takes a few months often to work through. There might even be part of the negotiation is we're going to close that unit, but we'll keep it open for 3 months. So even a CVA that's being announced today has a likelihood that the retail unit, all retail units, will trade through Christmas. So I don't think CVAs, you see that seasonality, administrations you do. So I think we, frankly, we have a number of retailers on our worry list. That can come through any time, frankly.
But are you feeling more confident? I mean, obviously we had a discussion 3 months ago, and the number has increased since then, the impact for 2018. So how do you feel today? Do you think that, do you feel more confident, or do you feel more, less confident, and that could further increase?
Mark, we track a lot of retailers. We have this worry list. Do you want to give a bit of flavour on that?
So we carefully track a watch list, and it's fair to say the size of that watch list has increased. It's still a relatively, still mid-single-digit percentage of the overall portfolio, but it has significantly increased in the last few months for all the reasons that we've talked about around the retail headwinds, and we're managing that proactively in the way that we've described. There's certainly the climate is not helping the potential for the CVAs.
I don't think we should be thinking, it's fine, we won't see more CVAs. I think it's highly likely we will. Christmas, I think trade has a high impact, so let's see what that brings. But I think we're certainly running the business on the assumption there will be continuing CVAs, actually increase slightly in terms of the run rate, but come back to the demand, the leasing activity, the ability to repurpose that space. That's the piece we're most focused on.
Perhaps one additional question, appreciate it may not be exactly the topic of the day, but there's been concern around crackdown at Chinese borders from tourists coming back with luxury goods from Europe. I mean, how do you view that, and how do you expect? I mean, it's early days, but what's your view on any impact on Vista from that, for instance?
Time and a very micro question for you to answer about Chinese border.
I have a bet with the finance director of Value Retail, and he thinks Vista Village is going to grow year on year 10% in the last quarter of this year. Now, I don't think they're going to do it. He's very confident. Unfortunately for me, so far, he's right in this quarter. And Vista has traded very, very strongly. So that's our best proxy for tourism coming in and spending a lot of money on Gucci and Burberry and Prada. It's always volatile. There's always stories coming out of China. But if you can execute well, if you've got the best inventory, best service, you'll be fine.
Yeah. Reminds Chinese tourists proportion.
Vista, 30 or 40% of all sales.
Thank you.
If you recall, though, a couple of years ago, they introduced import taxes on goods coming back into the country, and again, people said, oh, this will have a big impact on Chinese visitors and propensity to spend in Europe, but we haven't seen any impact, and there's still a significant differential between full price in China versus off price in Europe.
Hi, Charlie Ball from Bell Rock. You mentioned the new leisure operators like PubShack. Could you let us know roughly what sort of contribution you make to their fit-out costs in terms of, well, on top of any other incentive package in terms of rent through?
Those discussions are at a very early stage. At the moment, we're in discussion under certain locations around our portfolio. We're looking at space configurations. We're looking at space configurations at the moment. To be honest, we haven't even reached that stage, but we know that clearly when you're giving a shell unit, like you are, as I was illustrated in some of the lettings, that the contribution would be more than what you would see as an average on the principal lettings.
Any further questions?
Just one very quick one on the CVA hit. How big is the tenant incentive write-off within that 7 million figure?
Richard is telling me 2 million. I would say between 2 and 3. Unfortunately, we took a big write-off on Toys R Us in a unit in South Wales, which was about 1.5 million quid. That was in the first half. We've had a bit since, but it's less than half of the total impact for this year. And I would say it was about £2 or £3 million in total. So it's there, but it's not the biggest portion.
Okay, I think that looking like that's a question. So thank you all for coming along, first of all, this morning. Hope you've enjoyed the additional disclosure, a good discussion. A number of you I know are going out to Bullring. Please enjoy that day. You'll see a lot of this activity in action. We're here for a little while. If you want to enjoy a coffee and a further discussion, by all means, stay on. Otherwise, hope you all have a very good weekend. Thanks very much.